Welcome everyone to this webinar. We are focusing rates and returns, and this happens to be the first module that we look when we are studying quantitative methods. And this is a very interesting concept. This is also the most foundational concept which you will be using across the areas of your financial analysis, and that is interest rates. So when you're looking at rates and returns, you're actually looking at the interest rates. So while we call it as, we are actually looking at the interest rates. This is something that keep at the back of your mind. We are actually going to give you a structure. At the end of the session, you will have a framework in your mind as what exactly an interest rate means and how it's actually determined. Now, you should also understand, while this is something which is more generic and it could be applicable for a lot of those finance enthusiasts who are trying to get into pursuing CFA level 1, but this is something which is completely coming from the study material of CFA, and it actually covers the first core principle that you study in quant, rates and returns. So it is more applicable and appealing to those who are in the process of pursuing CFA level 1. Let's get into time value of money. So when you look at rates and returns, when you're looking at understanding interest rate, time value of money is something which is the first principle that you will encounter, you will come across. Now, time value of money, there is a basic premise, a basic assumption, which is a cash flow today is preferred to a cash flow promised in the future. So if someone is offering you a similar amount, so for a similar amount, there is no issue. If someone is offering you 10,000 USD today and says you can have 10,000 USD sometimes at time T1, I think there is no debate here. You will always prefer 10,000 USD today over 10,000 USD sometimes into the future. The issue starts when somebody says, I'm going to give you 10,000 USD today, or you have the option of taking 11,000 USD sometimes into the future. And that is where the whole confusion starts. And that is the premise of interest rates. But right now we are discussing time value of money. So keep at the back of your head that what we mean by time value of money is there is a methodology to create cash flows equivalent over a specific timeline. So at different dates, different numbers, different amounts of cash flow could be equated and made equal. So if you're looking at a timeline and you're standing at T0 and you have T1 and you have T2 and you have T3. And at T0, you have, say, 9,500. At T1, you have 10,000. There could be some number which might be here at 10,500 and say 11,100. And you might say that if you give me 9,500 today, or you give me 10,000 1 year from now, or you give me 10,500 2 years from now, or you give me 11,100 3 years from now, I really do not care. I'm indifferent to all of these four cash flow numbers. And that is exactly what time value of money tries to explain. Everyone will have a basic preference to have the consumption always in the present. So you want to have your consumption in the present, and if there has to be some reason and somebody is asking you to push the consumption into the future, there has to be some incentive and there has to be a mechanism to make all of these cash flows look similar or equivalent. And that is what you mean by time value of money. This is a very, very critical principle, what you call Finance 101. Keep this as a structure in your head. A similar amount of cash flow today is valued more than a promised similar cash flow sometimes into the future. Let's move ahead and let's understand what exactly is an interest rate. So interest rate, as you saw in the previous example on a timeline, is a rate of return that reflects the relationship between differently dated timed cash flows. So the same example, If you're looking at time t0, you're looking at time t2, you're looking at time t5, and if you have some number at any of these timeline, you might have a number here which says 5,800 USD. Now there has to be a mechanism, and that mechanism is an interest rate. That mechanism is an interest rate which actually makes this 5,000 appear at T0 or appear at T5, and all of these figures, so X3 and X1, and if you call it X2, all of these figures could be equated. And the number which actually equates it, that is the interest rate. It says, so the example I was giving you, a 9,500 USD today and 10,000 USD in 1 year are equivalent in value. Then USD 10,000 minus USD 9,500, it gives you USD 500 is a required compensation for receiving USD 10,000 in 1 year rather than now. Now, what it exactly means is, if you calculate this, you get a rate of 5.26. So if somebody says whether you want 9,500 today or you want 10,000 from now, this rate of interest of 5.26, if you discount 10,000 with this number, or you compound this number by 5.26% over a year, you will reach the same number. And this is what exactly we refer to when we say interest rate. Let's move ahead. Now, this also gives you a very different approach as to, and in a literary way and in real way, more to say, that this interest rate could be interpreted into 3 different ways. And we looked into all of these right now, but we'll just give you a structure. It can be considered as a required rate of return. We saw that, so 9,500, we're looking at 9,500 today. If somebody has to push the consumption into the future, then the required rate of return is 5.26%, which compensates you to push your consumption of today sometimes into the future. It can also be considered as a discount rate. Now, what is a discount rate? If you take this figure of USD 10,000 and if you discount it by 5.26%, you will reach to a number of 9,500 today. And third is the opportunity cost. We'll look into what exactly you mean by opportunity, what we mean by opportunity cost right now. So we looked into these examples, required rate of return, and we also looked at discount rate. Let's understand what exactly we mean when we say an opportunity cost. An opportunity cost is the value that investors forego by choosing a course of action. What do you mean by choosing a course of action? So when someone has resources today, so someone had 9,500 today, that person had the ability to consume it today itself, but we are forcing, or we are incentivizing the person to delay the consumption sometimes into the future. So there was an opportunity of consuming it today, but you're pushing or delaying the consumption sometimes into the future by giving a cost. That cost for the delay is what you mean by opportunity cost. So in this example that we were discussing, the party with USD 9,500 could decide to spend it today, but they have foregone earning 5.26 by consuming rather than by saving. So if you kind of decide to consume it today, you have actually foregone 5.26%. That is the opportunity cost. So 5.26, if you decide to consume it today, that is the cost which you have foregone. Or if you decide to consume it sometimes into the future, then 5.26% is a return which you'll be earning over a period of 1 year. And that is what we mean by opportunity cost. Let us now, you have understood what exactly is time value of money as a principle, that we always have a preference to consume sometimes now, then sometimes into the future, and a similar amount of money now versus future, the money now will have a higher value compared to the future. We also understood that an interest rate could be interpreted in 3 different ways. It could be considered as a rate of return, it could be considered as discount rate, and it could be considered as an opportunity cost. So these are the 3 ways in which an interest rate could be interpreted. And finally, we'll look into what exactly determines the interest rate. So until now, you got into the theoretical concept of what exactly is an interest rate. You understood it more from perspective of understanding the theory behind it. But now we are going into the specifics to get into a structure of what exactly is the component of determining. So if somebody says 9,500 today and 10,000 sometimes into the future are almost equal and you should be indifferent, then at rate of 5.26%, what does it comprise of? Why I should consider it 5.26 and why not 6 or 6.5 or 4, 4.5? That is a structure which we are now going to understand. First and foremost, let us understand broadly the broad concept that the interest rate could also be as so far, you understand the economics of demand and supply. So let me give you a very theoretical understand that this is a broad concept. So the macro principle says that interest rates will be decided by the forces of demand and supply. What exactly it means? What it means is there is a group of people who have the resources today. Okay, so they have that. In our example, they have that 9,500 USD today, and they also have the ability to delay consumption. Okay, so they are looking for opportunities and they are saying, okay, we are not going to consume the resources today. So we have 9,500, will not consume it today. Now this group of people, they are what the suppliers are. So they are the ones who are suppliers. Now there is another group who do not have resources. Okay, but they want the consumption now. They want to have the consumption. They do not have the ability to delay. They want to have the consumption now. Now when they want to have the consumption today, that's the pool which is called as the demand. Now there could be situations there is a heavy demand, so the demand pool is more. There could be a situation where the supplier pool is more. It's a situation of the forces between suppliers and the ones who are demanding it. If the supply is more, say for instance, a situation where the supply is more, if supply is more, rate of interest will be less. And vice versa. Similarly for demand, if demand is more, rate of interest will be more. Now, this is a core principle, but I have still not given you the framework which actually helps in determining the interest rate. Now, an interest rate framework overall, there are 5 components which determine what exactly the interest rate should be comprised of. So there is a risk-free interest rate. There's an inflation premium. There's a default risk premium. There's a liquidity premium. There's a maturity. We will look into all of these 5 components one by one and understand what exactly are these. So we first looked at the real risk-free rate. Now, what exactly is a real risk-free interest rate? Now, a real risk-free interest rate is actually an interest rate on any of the investment opportunities, or so as to call as bonds, issued by the sovereign. So we have seen there are many bonds issued by various governments. Now the rate of interest on those issued, because sovereign, they have an ability to raise revenue by way of taxes. So government opportunities to invest are considered as risk-free. Now there are many governments all across. We have the USA, we have India, we have UK, we have Pakistan, and which do we think should be a risk-free interest rate? Now, this is something interesting, and you just have to focus the context where you are analyzing. So that context, if you are analyzing an opportunity somewhere in Asia, Look at the geography. It could be India, it could be Bangladesh. Depending on the geography you're looking, if you're analyzing an investment opportunity somewhere in the USA, you'll have to look at short-term bonds issued by the government of the USA. And that exactly is a risk, because governments will technically not default, because they will have an ability to increase the revenue by increasing taxes on economic activities within that country. Next, we are looking at inflation premium. Now, this is very simple. Somebody who is delaying the consumption, pushing it sometimes into the future, knows pretty well that the ability of a fixed amount of money to purchase at time today will always be higher than the same amount purchasing power sometimes into the future. So you have to compensate for inflation. So the interest rate, the base rate is a real risk-free interest rate. You have to top it off with inflation premium. The next is default risk premium. Now, the investor always has the ability of defaulting. There could be situations of defaulting. And what do you default on? You either fail to make the payment on principal, or you make, so there is an interest payment. The person who is borrowing could default on interest or could default on principal. Both this requires that there should be a premium attached to the interest rate to calculate the interest rate. It also means something very interesting, that the default risk premium will be unique to the borrower. It will always be unique. And why will it be unique? Because every investor has a different credit profile. Now, this credit profile is something you will come across various situations as we move ahead. The fourth component is liquidity premium. Now, when you invest, when you actually delay your consumption and you invest your resources and you give it away to someone or you lend to someone, now the period during which you have actually lent the amount, during that period you do not have the liquidity. You have shifted your liquidity. Now, if there is a lack of liquidity, there has to be a liquidity premium. You should be compensated for liquidity premium. Now, how does the compensation happen? This compensation happens by adding a premium. But there are situations where you will have an ability to monetize your investment. Say, for instance, an investment in the equity, listed equity. If you're investing in listed equity, when you invest in listed equity or bonds which are traded in the market on the exchanges, now in both the situation, you have an option to go and actually monetize your investment on the stock exchanges or on the over-the-counter market, wherever these are being listed. Now, if that is something which is accessible to you, then the liquidity premium will be lower. So it's very simple. If there are opportunities to liquidate, to monetize your investments, the liquidity premium is going to be on the lower side. If there are no opportunities, the liquidity premium is going to be higher. And finally, we'll look at maturity premium. What does maturity premium mean? Maturity premium means the credit profile of the borrower where you have invested your resources will change over a period of time. So longer the period, that is, you lend the money at T0, and the period at which your money is going to come back is T5. So there is a 5-year maturity period. Now, the possibility of the credit profile of the borrower to go and become worse off is much higher compared to someone who has given at T0 and is supposed to get the money back at T1. So it says longer the maturity period, higher the maturity premium, shorter the maturity period, lower the maturity premium. So next time you come across and somebody mentions to you that we're evaluating an interest rate of, say, 5% or 6%, you should try and put all of these into a perspective, into these 5 boxes. Are you being compensated for all of this? And if you are supposed to pay, you should again look at the same way, that when you are paying someone, are any of these premiums, are you overpaying? So what exactly is the local, where exactly you're evaluating the geography, what kind of risk-free interest rate is there, what kind of inflation premium is there, what is the possibility of default, what is the structure for liquidity, and what is the horizon of maturity. These are the 5 components we should always keep into mind when we are looking at evaluating interest rates. We're going to stop here, and this should give you a thought as to when you move ahead and you start analyzing different kind of interest rate structures and instruments as part of your curriculum. Thank you.